Good afternoon. I'm John Davis, Managing Director here at Haig Partners, and I wanted to welcome back to our stage for a second time today John Murphy, who's going to talk to you about what franchises to buy in 2026. So,
great.
We're ready.
Right. Well, thanks, John. Glad everybody's finished their lunch, so I don't spoil it as I go through this. So thanks for sticking with us today for all these sessions. I'm going to go through a somewhat organized agenda here, looking at new vehicle opportunity with a focus on product. Talk about used and fixed opportunity with a focus on UIOs, units in operation. Market opportunity, competition, a little bit of pricing there, and round out with some conclusions on brands that we think you should be considering for your investment and reallocation of capital over time. So first on new vehicle opportunity, what you see here is a graph of the last 3-year CAGR by brand. Not a lot of surprise to folks in the room. You're operating in all these brands: Honda, Lexus, Mazda, JLR, Buick, GMC, Acura on the high end, Mercedes, Audi, CDJR on the low end. This is the data, right? What happens, I think, in a lot of investment decisions is people anchor on recency or what's just happened and don't focus on what's going to happen going forward. And as Alan, I think, very astutely, quoted somebody earlier of, every brand has their time in the tub, right? And everybody's got, is going to go back and forth on product cycles. Obviously, Audi and CDJR have had a rough run here. When we think about product replacement rates or product cadence going forward, the script does flip a little bit here. And I've been doing this product analysis for over 25 years. Talked to the automakers. They've been benchmarking off some of this work I've been doing for a very long time. What I've done is I've started recreating this here at Haig Partners. And it's really important when you think about your business going forward, because it's what we think, or I project, is going to happen going forward. And like I said, I've been doing this for over 25 years, reasonable level of accuracy. What you're seeing here is my projection, or our projection, of product replacement rates over the next 4 years by brand. And this is simply, not so simply, there's a lot of complexity in it, taking or forecasting every single product that's going to be launched by every single brand manufacturer over the next 4 years, estimating a volume that goes along with that product, and figuring out a product replacement rate. So it means that Audi roughly is going to generate a new product that will replace about 70% of its 2025 volume. Honda, Kia is a little bit behind that. The industry will do about 51.5%. Caddy, Lexus, and JLR are going to hit the bathtub. They're going to be low. And in the coming years, I do think Lexus is probably a little bit of an odd product cadence lull, and that'll pick up over time. So I wouldn't get too stressed about that. But the other brands at the low end are kind of more consistently at the low end. So this ranks what we think is going to happen going forward for each of these brands. And if you look at this, Audi, CDJR stores, even Nissan stores are better than the industry average. But it's also important to recognize that the industry at large is under-introducing versus history. So at 51.5%, the industry is traditionally, over the next 4 years, introducing about 63, 64%. So well over 60%. So the industry at large is got a sort of a lower product cadence than typical. We don't have the chart for the next 2 years on this, but if you were to look at the next 2 years, 26 and 27 calendar years, this number is about 15, 16%. So it's far lower than over these next 2 years and picks up in year in 3 and 4. And a lot of that has to do with automakers focusing heavily on EV powertrains and now canceling a lot of those. And they've been driven sort of sideways in product planning. There's a lot of time, a lot of human capital that's been invested and now is wasted and now being written off. And what we show here is our forecast for EV penetration by brand. And I would dare say that if you are looking at just brand specifically, you probably want a brand that's got a low EV penetration going forward, given what we're looking at over the few years from a regulatory standpoint and what consumers want. Cadillac is still leaning heavily into EVs. This may change over time, so they are responding. You can see the Volkswagen family, being Audi, Volkswagen, and Porsche to some extent, are course correcting a bit, not completely, but they're moving backwards. But what's really wild is when you look at the total industry, the dark gray bar is the 2025 EV penetration in the U.S., about 8%. I forecast, based on all the products that are going to be launched over the next 4 years in the United States, that the EV penetration rate around 2029 is going to be 8%. Now, I had a study that I did very similar to this in my prior gig that was done in May. That number was about 14% at the time. So we've dropped 6 points. If I looked at that study last year, it was in the mid-20s. And if I looked at that study a year prior, it was in the mid-30s. The industry is going through change in product planning and cancellation of products like it's never done before. It's why you see Ford writing off, $23 billion cumulatively. GM is just starting the write-off roll. I would pretty much guarantee we're going to see north of $100 billion written off at the automakers over the next 4 or 5 years as these product cadence or these EV products are pushed out or canceled. But it's really wild to recognize that the industry, from a product standpoint, is getting it, and they're moving relatively quickly. Now, I would say the folks that are on the left side of this I still have some concern given what's happening in the market, but they are higher-end buyers, so they may actually have higher penetration rates. But I would say the folks that are sort of in the middle of this to the right side are probably better off. So think about it. We've got Audi, Hyundai, Kia, Volkswagen, Honda, Mazda. The left side, they're doing well on product replacement rates. And then we have sort of the industry being Ford, Kia, Honda, Buick, GMC, Nissan, Lexus doing fairly well on the EV front. So there is a lot going on here, but I would say that what you've seen recently as far as a push on EVs and some of these underperforming brands is going to start reversing based on what I know about product cadence and sort of our forecasts on product by product in the U.S. market. The other thing I would just want to mention on brand exposure or sort of sales and product, we've had the slide up earlier. It's a reference point for you to look at which brands have the least risk. And if you obviously have more exposure to the U.S. as the vehicles that you're selling are produced in the U.S., you have a lot less risk. Mexico, Canada, a bit of risk. Europe, maybe a little bit more risk. But this is, once again, just a scorecard for you to keep track of. Domestic brands, Acura, Honda, Buick, GMC, Infiniti, BMW. These are the brands that are doing fairly well. The European brands are in a bit of a pickle. I would say the Japanese brands and the Korean brands are producing a lot over in Japan and Korea. So there is some risk that we're not showing on here. But the reality is, as you look at all of this, the brands that have been in the tub, like CDJR, Nissan, Audi, are returning the tide a bit. So there is some optimism for these underperforming brands. Remember, I'm trying to tell you which brands to buy going forward. On the fixed ops side, UIOs, we all know, are incredibly important. This is average UIOs per dealership in the United States by brand. This is total. Now, you guys generally focus on 5-year used vehicle sales or 0 to 5, as well as that's sort of the target area for fixed ops, the fixed ops business. So we've broken this down to 5-year UIOs by dealership, and there's not a lot of surprise here. Toyota, Lexus, Honda, Subaru, BMW, Mercedes, Hyundai are on the high side. The domestics are on the low side. Some of the lower ranging or lower volume luxury brands like Porsche are on the lower end. But the market is around 3,500, and you see a pretty significant range here. But a lot of the blue chip names, the names that you think about in general, are kind of on the high side. But this is the opportunity. The question is, how much of this opportunity is actually captured by dealers? And this harkens back to some of the comments that Aaron and I were going through in this morning's presentation on the aftermarket opportunity or post new vehicle sales that the dealers are not capturing. And when you look at this is a new metric that we're developing. Matt DeSantis and Eric Haig have been incredibly helpful with all these calculations because it's a lot of new data, and it's a lot more than an old guy like me can handle. They're doing a great job in helping me out with this analysis now. Is how much each brand is capturing of its same brand sales in the first 5 years. So Porsche is capturing about 65% of all Porsches that are sold from the age of 0 to 5 that are used. Right? So Porsche has a very high capture rate. That's incredibly important because that means everybody does consumer loyalty surveys and all that kind of stuff. This is the actual data as to what's actually happening in the market. We see Nissan just above. It's in the low 20s. So they're obviously having a hard time of holding on to their vehicles, repping them well in the same brand network. And the industry is about 41.5%. Now, I'd say there's clearly some good names and brands that are outperforming on the left side, but the industry at 41.5% seems pretty damn low, right? I mean, that's an indication that there's huge opportunity in used in your same brands. And as you focus on those same brands, you're focusing on fixed ops and that longer-term relationship with the consumer. This is a real opportunity, I think, for all brands, but certainly potentially the brands on the right. But it is an indication that the brands on the left have much higher consumer loyalty, and for that reason, have much more opportunity on used and fixed. So the brands on the left are clearly outperformers. But I would say that as you look at brands like Ford and CDJR, they're around the industry average. If you look at the luxury brands, they're kind of on the higher end. But this, I think, is critically important in measuring brand loyalty. Market opportunity. There's a lot of ways to think about this. We've sliced this to start with thinking about average transaction prices. And once again, as we kind of alluded to this morning, people generally disregard sort of real inflation or adjusted inflation in new vehicle prices. Inflation from 2019 to the end of 2025 was about 26%. ATPs were up about 31.5%. So the industry is not outstripping total inflation too much. It is a bit. But what you can see is there's some brands on the right that have moved tremendously more than the industry. And you have to question, if you're a Hyundai Genesis dealer, Infiniti dealer, or a Cadillac dealer, if you sold somebody a vehicle 3 or 4 or 5 years ago, and you've seen this kind of inflation or repositioning of the brand to a higher price point, is those folks that are coming back in your showroom, I think as Aaron said earlier, are going to have sticker shock or not have the right cars available to them because mid and lower end vehicles have been canceled. And I think this is a real challenge when you look at these brands on the right, to really think about sort of this brand loyalty and being able to maintain a customer that they sold a vehicle a few years ago. What's really surprising is the luxury brands are underperforming in general on inflation, meaning that they had the right product portfolio. They're not gouging the consumer. You could certainly argue some of these European brands should be, raising their price more than the industry average because of tariffs, but they're not. So their consumers are coming back and they're, dealing with pricing that is on a relative basis more similar to what they bought previously, so it'll be easier to retain them. So think about that as we rank the brands towards the end. And I just wanted to show you the absolute values here and just want to give you a kind of a small case study. We're trying to figure out, we're kind of going through brand by brand and thinking about, new models that are, coming in or new models that are canceled. And you look at Infiniti, and not to beat up on Infiniti, but they don't perform well in a lot of these metrics. If you look at Infiniti, they've dropped a lot of their cars, focused on high-end crossovers and their trucks. If you think about Infiniti QX80, right, their large SUV. Generally kind of competes with an Escalade, a Lincoln Navigator, maybe a BMW X7, or Mercedes GLS. If that consumer bought an Infiniti 3 or 4 years ago and they come back to the showroom and they're told, hey, listen, this is now about a $100,000 truck. Probably think it's 87 to 110 is really the range. You can get them a little bit higher than that. That consumer can look across the street and go to BMW, Mercedes, get an X7, get a GLS, get an Expedition, get a Navigator, or potentially an Escalade that might be a little bit higher. Why does that consumer stay in the Infiniti brand? Why would they? They shouldn't. I mean, logically, they shouldn't. No offense to Infiniti or the Infiniti dealers in the room or, Nissan, they shouldn't. So there's some extreme brand repositioning that's going on here that's really way out of bounds. It's going to make it very difficult for certain brands, I think, to really retain customers and help you thrive as dealers. I mean, Ford is a great example of canceling the Escape right now. That's creating a real hole in the Ford product portfolio. I've talked to Jim Farley a lot and try to understand how they're running the business. I actually think from a Ford perspective, in some ways, that's not necessarily the worst thing to do. But in the market, eventually that creates problems for dealers and eventually the consumer entering the Ford brand because you don't have an entry-level product. I mean, the Explorer is not exactly an entry-level product, and that's the lowest you got right now. But this repositioning of brands on transaction prices is critically important. The other thing is average new car throughput per dealership. That's, once again, no surprise to anybody in this room. Toyota, Lexus, Honda, BMW, Mercedes, Genesis, Hyundai Genesis are a bit on the higher side. The domestics are on the lower end of the range. Some of the lower volume brands are on the right side. So not too surprising, but I think when you look at that in conjunction, and this is a new stat that's out there, I haven't ever seen this before, with the vehicles that are sold in one state and registered in another, is an indication of brand competition that I don't think I've ever really seen before. And I think it's critically important because it means a number of things. It means that you might be over-dealered like CDJR, and your dealerships are shipping vehicles all over the country to hit sales targets and volumes. Well, that's good for the dealer that's doing it, because they don't have the opportunity to build a relationship with the consumer on the fixed ops or the used potential over time. And it's certainly bad for the dealers in the states where those vehicles are being shipped into, because they never even have a shot on goal with that consumer, and they're probably being undercut on pricing. Porsche is relatively high. A lot of 911s are shipping cross state, so that's not too big a deal. A lot of the luxury brands are kind of on the higher range. But on the lower end of the range is Honda. And that's really great, because if you're a Honda dealer, you're selling a car locally, it's staying in market, you have an opportunity on the fixed ops side, you got an opportunity on used, so really makes your business that much better. And generally, I think over time, this is going to be a factor that we dig into even beyond the state level. And we have data right now where we're going to be going to county level, local level, and even dealership level to understand where these real problems are, because the state level is a very easy thing to find sort of at first blush. We'll be digging a lot deeper, but understand where the competition within a brand is really out of whack. And I think a lot of folks that have CDJR stores might agree with that to some degree. And certainly have Honda stores might agree with this analysis pretty well. But if you look at that, I do think the brands that are farther on the right are far healthier than the brands on the left, save maybe Porsche and some of the luxury brands. So I think when you roll all these factors up and rank them from a new product perspective, from the UIOs, capture rate on the UIOs, and brand positioning, the rankings generally match what's going on in the market. And you think about the public stock market, or even what's going on in the private market here on dealerships, a lot of the rankings match very closely. So Lexus, Porsche, BMW, Mercedes are ranking very high on a lot of these metrics. If you look at the brands like Stellantis, Nissan, and Volkswagen, they rank fairly low on these metrics. So really, the catch to understand which brands you should buy is fundamentally to see which brands are ranking high relative to their multiples. And this is where you get into the nuances of trying to rank a brand versus a few hundred to a few thousand of these dealerships around the country, because every situation is unique. But as we look at this and wrapping up for conclusions, we got to, we'll have some time for questions, comments as well on this. Is the blue chip brands that everybody knows, Lexus, Toyota, BMW, and Mercedes, are clearly safe bets. Now, they're not just safe bets because everybody's like, I recognize the brand. It's a great brand. They're safe bets because they rank highly on UIOs per dealership, right? Throughput by dealership, capture rate or retention of the consumer by dealership. These are not brands that are just willy-nilly. I think everybody kind of likes to throw this around and be like, well, this is very obvious. It's not always that obvious. And when you look at these brands, it's also important to recognize when you think about their product cycles, they're actually below the industry average right now. So I think they're blue chip names. I think we all agree they're blue chip names, but you do have to keep an eye on them because over time, right now, over the next 4 years, their product cycles are a little bit on the light side, right? So although they're blue chips, there is a bit of risk. On the undervalued side, I put Honda, Kia, and Mazda. And what's important about these three brands is they have very high product replacement rates going forward. They're above the industry average, which means over the next 4 years, you're going to be getting some really good products that will help you perform in the market, that hopefully will help you build UIOs and feed the system over time. They happen to be fairly good on UIOs per dealership. They happen to be fairly good on UIO captures or 5-year UIO captures by dealership. But if I were to look at this group, it trades, if you were to think about it, 2 to 3 times cheap to the blue chip group. And I would call out Honda very specifically because a lot of the metrics on Honda are not too far off these blue chip names, right? They're right behind them or right on top of them. And it trades about two turns cheap to the blue chip names. Right now, obviously, each individual dealership will have variations in its multiple, but Honda really is an incredible value. I think Kia and Mazda with product portfolios are well misunderstood. They're trading at least 3 turns cheap, so they're interesting brands. Now, on the high risk, high potential reward, there's a lot of things that are going on besides the metrics that I just talked about. Hyundai dealers, you guys know better than I do, are dealing with stair steps and Jose's antics, whether you love them or hate them, that create some pressure on the business. Audi's has had some real trouble with brands or sort of product launches in the last few years of not having that much. Certainly some issues on Audi Care and how you guys are reimbursed. So it ain't pretty, right? But if you think about their product portfolio going forward, they're going to be launching pretty much all the Qs, Q3, Q5, Q7, and Q9, which is all new large crossover in the next 4 years. So there is some good product coming. Not saying it's super clean and doesn't have a lot of hair on it, but there is some real potential. And CDGR stores are going to get a lot of good product over the next 4 years. You got the Cherokee right now. You got the Ram 1500 in 3 years. The dealerships are trading cheap. Everybody hates them. So if you're looking for real return on investment, I think they are brands worth considering. But I'll take a step back and say, when you look at this, there's about 244 Lexus dealerships in the country. CDGR stores, there's about 2,400 of them in the country. This is an overarching framework about how to think about these brands. But as you look at each of those individual points and you come upon them, obviously you need to assess them, hopefully with the help with folks like us, and looking at them on an individual basis, because these overarching brand recommendations, I think, make a lot of sense and can help you call out some out of consensus or unobvious investment opportunities in these high risk, high reward section that I think would be really interesting. And I would say I would call Honda as a very, very interesting brand relative to the multiple that's in the market. With that, we're gonna take questions, but I just wanted to kind of wrap up real quick in something, sort of a personal comment of like why I'm here on the stage with you guys today and why I joined Alan and the team, because I think it's pretty important to recognize. As I think about the last 30 years on Wall Street, being an analyst, been involved in a lot of stuff, become part of the industry, done a lot of board presentations, some of the biggest IPOs in history, covered the whole value chain, automakers, suppliers, and dealers. I kind of thought it was time to move on from that job. And I really took a lot of time thinking about really where to spend the next leg of my career, potentially where, I'll finish it. And I would say, as I think about the value chain and dealerships are where the highest value capture is, the highest return is, and where the biggest opportunity is. So that's why I decided to join Alan and team and get involved in dealership M&A and helping you guys on strategy. But I will also say I did a lot of work on due diligence, and I know all the folks, in the business on what team to join. And, I'd say, as I think about, how I sliced and diced my investment opportunity, like you guys are all thinking about what you're doing with your businesses going forward, I think I picked the most undervalued part of the value chain with the most, with the best return, with the blue chip team, with Alan and team at Haig Partners. So I'm super excited. I'm super excited to be here with you guys. I'm looking forward to many, many years of helping you guys with strategy. I've been doing this with GM and Ford, suppliers, public dealers for a really long time. I think there's tremendous opportunity in your businesses that is, to be, tapped going forward. I would dare say when you look at the iceberg slide, there's potentially 50% upside in your ongoing earnings potential. I know from living in New York and spending a lot of time with the private equity firms and other folks, there's a tremendous amount of outside capital that wants to get involved here. So I think one of the analogies I kind of have always kind of thought about when you think about this business is it's kind of like the mini NFL, right? There's real potential upside in earnings per point. There's increasing capital that's going to be chasing it over time. It's tough to get approved like it is to buy an NFL team, which I think over time is going to create a lot of value for your folks if you execute, go after the right brands, and really think about maximizing value with the help of folks like Alan and everybody else here at Haig Partners. So we really appreciate your time. Happy to take questions, comments, criticism about this, the earlier analysis or anything else. I'm happy to hear anything you guys have to say. My contact information is here. The presentation is here. We'll open up for Q&A. Shoot, Don.
Murph, how do you measure risk relative to leadership gains at those OEMs? You mentioned Farley, Munoz, Mary Barkin eventually retire. Some teams are more conservative, some are very aggressive. But from your point of view,
So I think it's a very good question. I think you have to think about it from a person standpoint and then an institutional standpoint. And I think if you think about it from an institutional standpoint, and just kind of selfishly thinking about you guys as dealers, Toyota, I think, is the best at listening to you folks and understanding and listening to the customer and understanding what they should do in the market. That's critically important because they didn't get waylaid by the EV hype like everybody else did. They stayed the course. Hybrids are probably the best answer for the U.S. market. So I think from a sort of an institutional leadership standpoint, I would kind of point to Toyota as sort of best in class. I think the companies will remain nameless that are led by a person and also by a moment in time are the ones you got to be the most careful of. And, there's a lot of decisions that these CEOs have to make that are very difficult and seem crazy, are in some cases very logical. So I had a long conversation with Jim Farley about 3 years ago. I was working on the prior product portfolio study, which will remain nameless in this room, about the Ford Explorer, which will be launching, I think, next year. At that time, 3 years ago, there was a big question whether the Explorer should be just an EV product, kill the ICE, kill the hybrid, because that's the way the world was going at that time. Not that crazy a discussion, right? It's crazy now. And what he said, he's like, John, we've done a lot of work on this. We find that a lot of Explorer consumers are still towing. So we have to have an ICE product. Fast forward to last year, they killed the three-row EV, which was the Ford Explorer. And now they're just going to have an ICE and a hybrid version of the Explorer as it launches next year. So, you can be critical of some of these folks, but some of the decisions that they have to make without a lot of information, with a regulatory regime that's breathing down your back, they've made some big mistakes. I would say this investment in EVs is going to go down, and I've said this publicly in other places, as the biggest misallocation of capital in a corporate or industry, sort of industry a total in history, right? I mean, it is going to be massive. Now, I'm not saying the EVs are dead forever, but it is a colossal mess. So when you think about sort of what Toyota did, they didn't listen to the noise. They listened to the customer. They listened to the dealers. They had a solution. So I think, the answer is there's kind of one company that stands out, and the rest are all kind of fast followers, if that, and, kind of led by their nose and what's going on in the market at the time. Shoot.
Sway in this top, there are the heads up. You guys snapped the win. Great.
Well, we appreciate you guys coming, so thank you for making it great. We appreciate it.
Certainly that group played, and now they're a competition that made actually probably even start current year, but tail the last year. Where you see kind of transaction volume for the dollar amount. There's also
So the question is, where do we see the volume of deals going from a unit or number standpoint and a value standpoint? I don't know, Alan, if you want to take a stab at that one. I mean, I certainly have some ideas. I mean, I think in total it's going to increase on both vectors. I think that the number will go up because we kind of have this backlog of transactions that haven't been cleared because of massive uncertainty. USMCA in the middle of this year, I know it's pales in comparison to 232s. But, that could create a little bit of indigestion in the middle of the year. But I think we're going to see a backlog of deals and folks that, need to or want to get out of business. And I think valuations probably will fade a bit higher over time. They might not, have a huge step function up immediately. But I do think over time, as you look at the multiples and the implied returns, I mean, there's not a lot of things. Listen, I've been on Wall Street for 30 years. There's not a lot of things I could tell an investor to get involved in where they could have this. Now, there's a lot of human capital that you folks as operators are putting in that doesn't get accounted for on the dollars and cents when we're doing those returns. So that's real. So that may be sort of where you have that incremental cost and capital that's going in. But I think over time, the volume is going to trend higher, and the numbers, or sort of the multiples, are going to go up over time because they're too low, really, kind of across the board. The returns are very high relative to what you can get in other businesses, considering the risk profile. Once again, recognizing there's a lot of human capital and time that's put into managing these businesses. You're not playing golf all the time. You're actually working hard. So that's got to be costed in the equation.
Should get time frame with the local rollout, anything else?
When they normalize. So I mean, if I were to, well, this is I don't have an exact answer to this, but if you were to think about, the average multiple being 5 times, right? I mean, we're, plus or minus. The reality is that implies, dumb guy's math, a 20% return potentially, pre-tax. I mean, I think, you probably would want to see something that, on average would probably be, more in the 7 times range over time. How fast we get there, to get to sort of something that's more of a mid-teens return. I don't know how fast that'll happen. I mean, I know there is a lot of incremental capital coming in. I think one of the things in the 5 months after joining the team, I am surprised at is how much capital is available in many different forms to dealers, and how much incremental capital from the investment community is looking at this in a way that they can't step in because they're not operators. They can't get approved. So you guys are the gatekeepers in many ways. So you really hold the cards in this in a big way. But I think over time, as that capital comes in and becomes bigger, maybe as a minority, owner, or, have it, in partnership with great operators, the multiples will go up. That'll be years, not a year, but I kind of believe that's going to happen. Shoot.
Got that. From a brand perspective, you saw from Aaron that total volumes coming down to 15.8-ish this year. We hear from so many of these brands. Honda are projecting 4 or 5% growth. Mercedes 8 or 9%. Stellantis 26%. How do you factor that into these? What's your crystal ball? This stuff.
So I would say if you listen to automakers, we're going to be in a 50 million unit market. No offense, Daryl. All right. I mean, that's just the way it's been. I've been doing this for almost 30 years, and you listen to their forecasts, and it's always going to be, a market that's, 2x reality. A lot of things I've done analysis to kind of adjust for that over time. So I think they're probably a bit overly optimistic. However, I would say the one chart that we showed this morning about capacity utilization running around 70%, and them not pumping, volume, much, in a way that's overburdening. Inventory's gone up, but it's not totally out of hand. They aren't really kind of pushing to drive market share the same way as they were from 2000 to 2009. I'll just go back to that example I gave of nobody screwed up 7 ways to Sunday like GM was back in the early 2000s, right? There's just no manufacturer that's in that position. So I think I kind of fall back when I think about my crystal ball. Is, Alan Greenspan once wrote this very intense white paper about forecasting auto demand. The reason he did it was because this is the driver of the economy, right? This is how the economy goes into downturns, and this is how the economy recovers, and it is a key driver of the economy. It's no doubt about it. So Greenspan wrote this paper, factors he came up with, which was very consistent with the way people thought about it. It's consumer confidence, disposable personal income per capita, access to credit, and sort of employment levels, right? Those are the 4 factors, high correlation with auto sales. The problem with that is that auto sales drive those factors. So this is a high, circular reference, and you could say it's correlation, what's causal. But when you look at this, and this is kind of where the light bulb went off in 2009, I'm sitting there, I got sell ratings, I got companies that have gone bankrupt. It's kind of a mess. It's like, well, can this keep happening? And you're like, you look at this and you see the total number of vehicles on the road shrink for the first time in history. You're like, that can't keep happening if we're going to keep trying to drive 3 trillion plus miles in the United States. So I think that's where the light bulb went on. This is a capital goods replacement cycle industry. Fleet managers operate that way much more than the consumer does. It's a whole industry, right, that does this. The individual consumer is not thinking that way, and that's why the consumer confidence overlay is so critically important. If I run those numbers, I really do believe that if we get the right price points in the market, so stuff that's, probably in the $40,000 plus or minus range, we could get to something that would be closer to an 18 million unit sales rate by the end of the decade. I think that the industry is keeping a lid on this because they're making a lot more money at lower volume levels. So I'm not sure, we're going to get there. And if I put my crystal, think about looking into a crystal ball and give you an estimate for this year, I think we're probably going to be in the low to mid 16s. I think we're probably going to be a fair amount higher than that 15.8. Not wildly. Last year we finished at 16.2, so it's a good increase. But I think that's probably where I'd land on the march to potentially get into that 17 to 18. I think the governor is just going to be the automakers focus on the right product and the right mix to drive profitability higher for them. So I think that's where I'd land right now. Got a few more minutes or shoot?
That's kind of a double click that answer. When you think about an 18, 19 SAAR opportunity, sales opportunity based a lot on price point. So that opens up that lower price point and for a new entrant, new competitor to model. The eye quickly goes to, that the Chinese competitor coming into the U.S. or figuring out a way to get to the U.S. What is your thought on the probability of that happening to fill that gap?
I think in the next 3 years, it's very low likelihood. Over the next 10 years, it's 10 years roughly it's an inevitability. I don't think there's any way that that's not going to happen eventually, right? And the reality is, if you drop a regular plant into a state, 250,000 unit capacity plant, it's a standard plant, it's 3,500 to 4,000 jobs directly. 10 to 1 multiplier in the supplier park and all the other businesses that benefit from it. So what senator and governor is going to say, we don't want your, $3 to $5 billion investment. We don't want your 40 to 50,000 jobs you're going to create in our state, because they're going to have to produce, they're going to have to produce here in the U.S., I would think, in any agreement. So I think that, eventually there's going to be, a break in the dam. Somebody's going to work their way in. The thing that is a little bit difficult right now is they're not all EV. A lot of these exports, when I showed 6 million units, they were increasingly ICE and hybrid. I'll tell you many stories over the last decades about being in China and their problems with powertrain. They went with EVs, not for the environment, because they couldn't make ICE. They're starting to get ICE capable. So once they get ICE capable and they can get a state to give up the goat there, I think they're going to have a real opportunity at the low end of the market to enter the U.S. And I would think everybody in this room, maybe including myself, maybe Alan, we'd all want to raise our hand and get one of those dealerships, right? I mean, and that's, I think that's, I think that could potentially be a great opportunity. There's going to be a time and a place for that to happen. I think what Canada is doing right now about importing the 49,000, EVs right now to 70,000 from China is insanity. You've just killed 10,000 jobs in the North American market. That's not how we want to do it. If you're going to do it, you're going to produce here, you're going to employ Americans, you're going to use U.S. suppliers, you're going to use U.S. technology, and I think they'll be here. And their motivations are a little bit different than standard profit and returns. It is to have these, large global competitors that are, out of China. Listen, we haven't with GM and Ford, Chrysler, right? We bailed out GM and Chrysler in 08 and 09. It was important to the U.S. economy. It's important to the U.S. psyche. Europe's got their national champions. South Korea's got their national champions. Japan's got their national champions. The Germans have their national champions. This is not some wacky Chinese thing. It's the Chinese want their national champions. And to be true national champions, you really need to be global on the global stage. And this is the market where the money is made in the global stage. So they're gonna want to be here. I think it's within the next decade. The next couple years might be a stretch. Thank you very much for joining us.